Hi everyone, Hortencia Torres here again. Thank you so much for joining me for another episode of our series on the IRS collection process. Today I will be explaining what a substitute for return process is and what it means for you as a taxpayer. But before we begin, however, I would like to remind you to download and read our free ebook, Stop IRS FEAR, a taxpayer's guide to the IRS collection process. In it, you will find a lot of helpful and easy to digest information on all the topics we've been discussing in our videos. And now, on to today's topic, substitute for return. Let's assume that you neglect to file your tax return when it's due. In these cases, the IRS has the power to file a return on your behalf. And this process is called a substitute for return, or SFR. How convenient, you might be thinking. Well, I'm sorry to tell you this is everything but convenient. When filing a substitute for return, the IRS gauges your current income using information provided by employers, banks, and other payers in any given tax year. The problem is that when calculating how much tax you owe, the IRS will use the worst case scenario. And this means that it will not take into consideration anything that could lower your taxes, such as the fact that you may be married, have dependents, or maybe you're eligible to claim certain deductions or certain credits. Therefore, you could end up with a much higher tax debt than if you simply would have filed your own taxes. That was our brief overview of the substitute for return process. I hope that you found the information useful and learned something new today. I will see you in the next video. Until then, don't forget to download our free ebook, Stop IRS FEAR, a taxpayer guide to the IRS collection process.